Imagine you walk into a bank branch. There are tellers, loan officers, people helping you open a checking account. You deposit your paycheck, maybe you take out a mortgage. That bank makes money by taking your deposits and lending them out at a higher interest rate than they pay you. That is banking. But there is another kind of bank that looks almost nothing like this. No tellers, no branches on street corners, no deposit accounts for ordinary people. Instead, this bank advises giant corporations on billion-dollar acquisitions, helps companies go public, trades billions of dollars of bonds and stocks every day, and manages money for pension funds and sovereign wealth funds. This is an investment bank. And the question is, how does a business with no deposits and no traditional lending actually make money? The answer is more interesting than you might think, because an investment bank is not really a bank in the ordinary sense. It is a services firm. It sells expertise, access, and execution. It gets paid for solving problems that are too complex, too large, or too sensitive for companies to handle themselves. To understand how investment banks make money, you have to start with the basic problem they solve. A company that wants to grow needs capital. It can borrow money or it can sell ownership. But raising capital is not as simple as putting a sign outside the office. There are legal requirements, regulatory approvals, pricing decisions, and the challenge of finding buyers for millions of shares or billions of dollars of bonds. A company might also want to buy another company, but that involves valuation, negotiation, financing, and regulatory clearance. Or a company might be struggling with debt and need to restructure. These are not problems a company can solve with its internal finance team alone. They require specialized knowledge, relationships with investors, and the ability to move large amounts of capital quickly. That is where the investment bank enters. Investment banks make money primarily through 4 broad categories of activity: advisory fees, underwriting fees, trading revenue, and asset management fees. Each of these works differently, involves different kinds of risk, and generates different amounts of revenue. Understanding each one is the key to understanding the entire business model. Let us start with advisory fees. This is the most straightforward part of the business. A company hires an investment bank to advise on a major transaction. The most common transaction is a merger or acquisition. Company A wants to buy Company B. The investment bank advises Company A on how much to pay, how to structure the deal, how to finance it, and how to navigate the regulatory process. Alternatively, the investment bank might advise Company B on whether to accept the offer or how to negotiate a better price. The bank gets paid a fee for this advice. The fee is typically structured as a success fee, meaning the bank gets paid only if the deal closes. This is crucial because it aligns the bank's incentive with the client's outcome. If the deal does not happen, the bank does not get the big payday. The fee is usually calculated as a percentage of the transaction value. For a mid-sized deal, the fee might be 1 to 2% of the total value. For a massive deal worth tens of billions, the percentage might be smaller, perhaps a fraction of a percent, but the absolute dollar amount can still be enormous. In 2025, 6 acquisitions of U.S. public companies included sell-side fees of at least $100 million for a single bank. That is $100 million for advising on one deal. Advisory fees are considered a high-margin, low-risk form of revenue because the bank is not putting its own capital at risk. It is selling expertise. The advisory business is not limited to mergers and acquisitions. Investment banks also advise on restructurings when companies are in financial distress, on activist defense when hedge funds try to take over a company, and on private capital transactions. In each case, the bank is getting paid for its advice and its ability to execute complex financial transactions. The second major revenue source is underwriting. This is when a company wants to raise money by selling stocks or bonds to investors, and the investment bank helps make that happen. The bank does not just advise. It actually buys the securities from the company and then resells them to investors. This is called underwriting. Here is how it works. A company decides to go public. It wants to sell $100 million of new shares. The investment bank agrees to buy those shares at a certain price, say $95 million, and then sells them to its clients and other investors at the offering price of $100 million. The difference is the underwriting spread, which is how the bank gets paid. For an initial public offering, the spread might be 3 to 7% of the total amount raised. For a debt offering, the spread might be smaller, perhaps 0.5% to 2%. In 2025, global investment banking fees reached approximately $97 billion, making it the third best year on record. Underwriting involves risk because the bank is putting its own capital on the line. If it buys the shares and then cannot sell them to investors at the expected price, it takes a loss. This is why underwriting is considered a higher-risk activity than advisory work. But it is also potentially more lucrative, and it deepens the bank's relationship with corporate clients who often return for future financing needs. The third and often largest source of revenue for investment banks is trading. This is where the bank acts as a middleman in financial markets, buying and selling securities for clients and sometimes for its own account. Trading revenue comes in two main forms: agency trading and principal trading. In agency trading, the bank executes trades on behalf of clients and charges a commission or fee for the service. The client wants to buy 1 million shares of a stock. The bank finds a seller, executes the trade, and charges a small fee per share. The bank does not take any market risk because it is simply facilitating the transaction. In principal trading, the bank takes the other side of the trade. A client wants to sell a large block of bonds. The bank buys the bonds from the client, holds them on its own balance sheet for a period of time, and then sells them to another buyer at a slightly higher price. The difference between the buying price and the selling price is the bank's profit. This is often called market making. The bank provides liquidity by being ready to buy or sell even when there is not an obvious counterparty on the other side. In return for taking on this risk, the bank earns a spread. Almost all fixed income trading is done on a principal basis, meaning it passes through the bank's balance sheet. Equity trading is more mixed, with some agency and some principal activity. The trading business is highly sensitive to market conditions. When volatility is high and trading volumes surge, banks can make enormous amounts of money. In 2025, global investment bank revenues grew about 10%, led by a surge in equities trading. The Coalition Investment Bank Index, which tracks the 12 largest investment banks globally, climbed 14.5% to $174.7 billion, driven by a 20.7% increase in equities revenues and a 10.5% increase in fixed income, currencies, and commodities revenues. Trading revenue is volatile. It can disappear quickly when markets are calm and volumes dry up. But when markets are active, trading can generate more revenue than advisory and underwriting combined. This is why investment banks pay so much attention to their trading desks and why they employ thousands of traders, quants, and risk managers. The fourth revenue source is asset management. Investment banks manage money on behalf of clients, including pension funds, endowments, sovereign wealth funds, and wealthy individuals. The bank charges a management fee, typically a percentage of assets under management. If a bank manages $100 billion and charges 1%, that is $1 billion in annual fee revenue. The bank might also earn performance fees if it beats certain benchmarks, though this is more common in hedge funds than in traditional asset management. Asset management is attractive because it generates recurring, predictable revenue. Unlike advisory fees, which depend on deal activity, or trading revenue, which depends on market volatility, asset management fees come in steadily as long as the bank retains the client's assets. This is why many investment banks have built large asset management divisions. They provide a stable revenue base that can offset the ups and downs of the more cyclical businesses. Beyond these four core areas, investment banks also generate revenue from other activities. Prime brokerage is a significant business where the bank provides financing, securities lending, custody, and trade execution services to hedge funds. Prime brokerage revenues at the top 12 banks globally jumped 51% in the first half of 2026 compared to the same period in 2025. Banks also earn interest income on the money they lend to clients for trading and other purposes. They earn fees from providing research to institutional investors. They earn revenue from foreign exchange services, from commodities trading, and from securitization, where they package loans into securities and sell them to investors. It is important to understand that investment banks do not operate in isolation. Their different businesses are deeply interconnected. A bank that underwrites a company's initial public offering is well positioned to advise that company on future acquisitions. A bank that provides prime brokerage services to a hedge fund is well positioned to execute trades for that fund. A bank that manages a pension fund's assets is well positioned to advise that pension fund on large transactions. The relationships are the real asset, the fees are the harvest. This interconnectivity also explains why investment banks are structured the way they are. The advisory and underwriting businesses are grouped together because they both serve corporate clients. The trading businesses are grouped separately because they involve different risks and require different expertise. The asset management business might be a separate division because it has a different client base and a different revenue model. But all of these pieces work together to create a financial institution that can serve almost any need a large corporation or institutional investor might have. The scale of these revenues is staggering. In 2025, J.P. Morgan generated roughly $8.6 billion in investment banking revenue, followed by Goldman Sachs and Morgan Stanley. Goldman Sachs's Global Banking and Markets division produced record revenues of $41.5 billion for the year, up 18%. Global investment banking fees reached $97 billion. The broader corporate and investment banking revenue pool reached $827 billion in 2024, with growth continuing into 2025. But revenue is not profit. Investment banks have enormous expenses. They pay some of the highest salaries in the world to attract top talent. They spend billions on technology and infrastructure. They maintain vast legal and compliance departments to navigate the complex regulatory environment. They set aside capital to absorb potential losses from their trading and underwriting activities. The profitability of an investment bank depends on its ability to generate high-margin fee revenue while controlling these costs. The economics of each business line are different. Advisory is high-margin and low-risk because it does not require the bank to put its own capital at risk. Underwriting involves some capital risk but can be very profitable when markets are strong. Trading involves significant capital risk but can generate enormous revenues in volatile markets. Asset management is low risk and provides steady, recurring revenue but requires scale to be profitable. This is why investment banks constantly adjust their mix of businesses. When underwriting is booming, they allocate more resources to capital markets. When trading is volatile, they might pull back from certain desks. When asset management fees are growing, they might expand their wealth management offerings. The business model is dynamic, constantly adapting to market conditions and client demand. The deeper insight is this: an investment bank is not really in the business of banking. It is in the business of intermediation. It stands between companies that need capital and investors who have capital. It stands between buyers and sellers in financial markets. It stands between clients who need advice and the expertise required to execute complex transactions. Every dollar an investment bank earns is a fee for making a connection, facilitating a transaction, or providing a service that its clients cannot easily provide for themselves. This is why understanding investment banks matters beyond just knowing how they make money. It reveals something fundamental about how modern capitalism works. Large companies do not operate in isolation. They rely on a vast ecosystem of financial intermediaries to raise capital, execute transactions, manage risk, and navigate complexity. Investment banks are the most sophisticated players in that ecosystem. They are the architects of the deals that reshape industries, the engines that keep capital flowing, and the institutions that connect the world's savers with the world's borrowers. The next time you hear about a massive merger or a blockbuster IPO, you will understand that behind the headlines, there is an investment bank earning a fee for making it happen. And behind that fee is a business model built on expertise, relationships, and the willingness to take on risk. That is how investment banks actually make money. Not by taking deposits and making loans, but by standing at the center of the financial world and charging for the privilege of being there.